All righty. Good evening, everyone, and thank you so much for joining us. In case you're wondering, you're in the right spot. This is our Parent Academy Financial Wellness Series, and we are joined by our community partners, Twin Star Credit Union. This, by the way, just in case you were counting, is part 4 of our series, and our topic tonight is managing credit. So if you've missed out on any of the others, please feel free to check out our Parent Academy playlist on the Clover Park School District YouTube channel. We have talked about in previous webinars, talked about budgeting, paying for college, ID theft, and now we're talking about managing credit. So in case you're new to getting a credit card, maybe you're a college student, you're thinking of going to college and you're thinking about needing a credit card, or maybe you've been in the game for a long time. We all know it's pretty easy to get credit, but it's quite difficult to get out of debt. So tonight our presenter is Lamarco Mitchell, the Community Engagement Manager at Twin Star Credit Union. And we are delighted to have you, Lamarco, for this really important topic, because I don't know about you, but it was super easy to buy things thinking, on credit. And then you get that credit card statement. I remember being right out of college, get that credit card statement, and you don't even realize what you have purchased.
Mm-hmm.
It's a little bit of remorse at that moment.
I was
Buyer's
right
remorse.
there with you, Holly. I was right there with you. And they were giving away the credit cards like it was candy back then,
Yep.
too. Yeah. And, when you cover that minimum payment, it just doesn't really cover a lot.
No, it doesn't.
Yeah. Well, I am so glad to have the opportunity to come and present again. It's been, probably 4 months, 2 months since I've been able to present. And, like you said, this part, the credit piece is so easy. It's so easy to get in trouble. But a lot of people just don't really understand what, how much of your life, just daily life, is impacted by your credit and your credit score. So today we're going to talk a little bit about that, and just hopefully we can give some people some tidbits to keep them out of trouble, give them some good habits, some good habits for them to work with, so that they get outstanding credit scores, and that they're able to manage that credit and kind of ease on through life, paying the least amount of interest that they
Yes.
have to.
Yes. And this is also wonderful if you're not sure quite how to talk to your student or your kids about credit. We're hoping to give you some great tips and words and explanations of how things work to help you with that conversation.
Yes. And to help us. So just today, we're just going to talk about, what are the different types of credit. Generally, we're going to talk, specifically, we're going to talk about, installment credit and revolving credit. So installment, a lot of people call that term loans. We're going to learn about the credit reports. I'm going to share about the credit reports, talk about ways that we can build and maintain your credit, and then talk about the importance of monitoring your credit as well, because once you have the credit, you have the great credit score, you want to make sure that no one's going to mess it up by taking your ID. For those of you that were able to tune in last month with about the ID fraud and ID theft, great information. If you haven't had a chance to check that out, I would really, really, really recommend that you check that presentation out as well. Okay, so credit. What is credit? Basically, credit is, you're borrowing money. It's borrowing money. You're getting lenders to give you money, but there are also some strings attached to that money, typically in the form of interest, which is the cost of borrowing that money. And then the credit reports and your credit scores are what lenders use to determine whether you are credit worthy, or as well as what interest rate they're going to charge you for borrowing that money.
Lamarco, I'm going to turn my video off, my camera off, just because our sound is lagging just a bit, and I think that will help it. So okay. I'm here. I'm just going to turn that off just so that will help our audio.
Okay. So as I mentioned, just the slide before, there are two types of credit. So the first one we'll talk about is the installment credit, or term credit. And these type of loans are typically the loans for the big purchases. So we're looking at your homes, your cars, student loans. And so they're called installments or term credit or term loans because there's a specific term or time period that you have to pay that money back. All right. And then they're also secured, which means that there's collateral. So your home is the collateral. If you don't pay your loans, if you get behind on your loans too far, or you default, that home that you borrowed the money to purchase can be taken away by the bank or by the institution, as well as a car and such. So, what contributes to the cost of that loan is the interest rate, the amount of payments that you have, or the terms, the length of the payments, and then how many payments or how much money you pay above and beyond your monthly installment. So for example, if you have a $50,000 student loan at 6.9%, we talk about the term is 5 years, you're borrowing $50,000. We talked about the length of the payments or the term. So if you pay that loan off, that $50,000 in 5 years, each one of your installments or payments is going to be $987. And by the life of that loan, by the time you pay it off, you're going to actually pay off $59,262. So that $9,262 is the amount of interest that you paid on that loan for that term. But if you look here at the 20 years, same terms, same interest, sorry, but the amount of the payment installments is drawn out to 20 years, you're actually going to pay $42,000 in interest. I mean, the benefit of drawing it out longer is that you have a smaller monthly payment, but as you can see, that smaller payment combined with that interest, combined with the amount that you borrowed, equates to a lot more money that you're paying. So the cost of that loan, that $50,000 loan, was actually $42,000. So you're actually going to pay $92,316 on that loan. And then 10 years, you can see that's just right there in the middle. All right. Let me go back one. And then in terms of, if we look at a mortgage, $100,000, which would be nice if homes were still $100,000, would be beautiful. You can see how that interest rate affects that loan. And the thing about these installment loans is that interest that you're paying is actually front loaded, which means that, from the beginning, you're paying more of the interest than you are the principal or the amount that you borrowed. So if you look at this example, $100,000 mortgage for 30 years, 4.5%, right? That first payment, the payment's $507 a month. With that first payment of that $506, $375 of that dollars is actually going to the interest on that loan, and only $132 is going to the principal or the amount that you borrowed. And so as you make more payments, more money is going to be going to the principal and less to the interest, to where you get down to the last two payments. As you can see, the greater portion of the money is going to that principal rather than interest. So at payment number of 359, it's actually $502 or $503 that's going to the principal or the amount that you borrowed, and $3.78 is going to that interest that you borrowed. So, but by the time you get down here, though, look how much you have paid in interest. You've paid $82,000 in interest for that $100,000 loan. So by the time you pay this loan off, you will have paid $182,000, $82,406. Okay. Now, so again, we talk about the principal or the amount that you borrowed, the $100,000 that you borrowed, the term or the years, the 30 years that you borrowed it for, and then the interest at 4.5%. So when we look at this as a 30-year mortgage as opposed to a 15-year mortgage, right? You'll see that same amount, $100,000, but the term is actually 15 years this time. The interest rate is the same. What it affects is you're going to have a higher payment. So it looks like you have about $260 odd higher payment each month. But when you look at it, look here, you'll see that $389 or $390 of that principal on that first payment is going, or $390 of that payment is actually going to the principal, so the money that you borrowed, right? And $375 is going to that interest. So you have more money that's going to the principal. So you're paying on that principal faster, the paying on the money that you borrowed faster, which in turn decreases, the length that you have to pay that off. And by the time you get down here to, the 176th or 179th payment, you'll see that, $759 is going to that principal. And only $5.71 is going to that interest. But look here, the amount of interest that you paid, where it was $82,400, you actually have paid $37,700 in total interest. So that's the benefit of a shorter term loan or installment, is that you're paying less money. But the bad part is, for those that can't pay it, you're paying more money each month. So depending on finances and whatnot, some people need to have more money each month to make their monthly payments and bills and everything that they need for their livelihood for that month. So it's really a balancing game, and you have to find the right product or the right terms that fit for you. But there are things that you can do to help move those payments along or to pay those loans off faster and decrease the amount of interest that you are paying on your loan. So you may get that 30-year loan, but instead of paying every month, maybe you pay every 2 weeks, so the same amount of money that you pay, so your payments will be the same, but instead of paying that $506, you'll break that down to maybe $253 each month, or every other week. So in turn, what you're actually doing is you're making one extra payment each year, and over the course of 30 years, that's 30 extra payments. But so you're paying more, obviously, on the money that you borrowed. So you're going to make more payments on that principal, and it can affect that loan. You can save up to 18% on that loan over the course of the terms of that loan. Another thing that you can do is instead of paying that $506 as we had in that last example, maybe you pay $606 or $650. So you're putting extra money down, you're putting extra money to the payment. Make sure though, when you do this, that you check with your bank and let them know that each payment or the amount above and beyond your scheduled payment or the amount that you would plan to pay goes to the principal, because you don't want to be paying that money in that loan and be surprised at the end when you find out that the extra money was just going to the interest and not the principal. So you want to make sure that you have that discussion and let them know and work out with them to make sure that what you intend to have happen is actually what is going to happen with that extra money. So the benefits of installment loans are, one, because typically they're bigger purchases, that there are lower monthly payments, all right, and you get to draw those payments over a longer period of time than, say, the revolving credit. Another option that these loans provide you is that you have the opportunity to refinance them, and basically that means borrowing money to pay off the loan, and using the equity or the amount, which is the value of your house minus the loan, that you still have, the amount of the loan that you still have to pay. So using that money to pay down the loans. And typically, the goal of when you refinance is that you want to have a lower rate for a shorter period of time. And a lot of people refinance because rates are better than when they receive their first loan, which is, unfortunately not the case now with inflation. The price of borrowing money has increased, but there are still maybe other benefits as well. But if you need some money, or if you need to free up some monthly expenses, you may be able to, again, borrow money to bring down the payments of what you pay already and draw that out again for the longer period of time. I guess the bad part of that is that once you do that, that interest, that money that you're borrowing, the interest is front loaded again. So when you start paying, you're going to be paying that interest, off on the loan, more of that in the beginning than you are the actual amount of the loan. So you have to really understand where you are in your situation is. So you want to make sure that you talk to your lender about that, and just make sure that you're making the right decision for yourself. So the other type of loans that we're talking about, other type of credit, is the revolving credit. And typically this is the ones that can get us in trouble. So we're talking about credit cards. We're talking about, lending, borrowing money, or not necessarily borrowing money, having a certain credit limit with an institution that we can use as we wish. And then we have monthly payments that we pay. And when we make that payment, we're just paying down the debt again. So the amount of credit that we have, fluctuates. The available amount of credit fluctuates depending on how much of our, of our debt we're paid down on. Okay. So the thing about credit cards and revolving credit is that, like Holly said, you can get in trouble. If you max out your credit cards and you're making those minimum payments, basically you're just paying, the interest on those cards. You're not making a dent into that payment. And as you continue to just pay the minimum, you're going to incur more and more interest on the debt, and you're just going to be paying, the interest rather than the debt. And you won't be able to pay down the amount of money that you borrowed or that debt. So you want to make sure that if you do have revolving credit, you want to be diligent about paying off as much as you can each month, to ensure that you don't get caught in that loop and you don't get in trouble. So here's just an example of what I was just talking about. All right. So the minimum payment trap. If you have $5,000 in credit, all right, and in debt, I'd say you have $5,000 in debt on that credit card. If you're paying 15.9% on that, if you make the minimum payment, right, it's going to take you 17 years, almost 18 years to pay off that $5,000. And by the time you finish paying it off, you will have paid $10,658, right? So that's why you want to make sure that you pay as much as you can down on your credit card debt, because if you don't, you are going to end up again paying way more money than you would have if you just were diligent and tried to pay as much as you can down. And so again, each payment only covers the interest. If you do the minimum, it only covers the interest for that pay period plus a certain percentage of the debt. Typically your minimum payment is, your interest plus 1 or 2% of how much money you have, how much debt you've run up on that card. Okay. So please, please, please don't get caught up in the minimum payment trap. Do everything that you can to stay out of it by paying, more than a minimum payment. Ideally, it'd be, twice the minimum payment if you're not able to make the whole payment each month. So again, the pros and the cons of the different types. So installment loans are great for your large debts, your mortgages, your cars again. You have a long period of time, it makes the payments where you're able to pay those payments as opposed to, one huge, $100,000 payment in cash. You can refinance these debts, which is good. And the interest rates are all, definitely almost always lower than revolving credit. And then, the cons we spoke, that interest is front loaded. So you're paying that interest off before you're paying the terms of that, before you're paying off the amount of money that you borrowed or before you're paying off the loan. You got to pay that interest first. The pros of revolving credit, there's that flexibility. So you can pay, there's not a certain amount of money that you have to pay. You have a minimum payment, but again, that can get you in trouble. Some of these cards offer incentives, so you can get cash back. A lot of like the airline miles or the airline points you can use to purchase airline tickets. But with that, sometimes typically those credit cards are going to have higher interest rates than just a no frills type of credit card. And then when you pay that minimum, pay more than that minimum payment, your interest charges are decreased right away because you're paying, on the number of purchases that you have rather than, for the whole amount. Oh, so now credit cards are credit reports and your credit scores. So what is your credit score? Your credit score, like it says, is a number between 300 and 850. And basically it is the bank way of figuring out if you are the likelihood of you paying off the debt or the loan that you borrow from them or that they extend to you. So the lower the number is, the more risky you are as a borrower, and the higher the number is, the better your score is, the more likely you are to pay your debts. And so there are more than, there are different types of credit scores, different providers of credit scores, but FICO is the one that, we know the best and that is used most often. So how are your credit scores determined? What determines your credit scores? So here are the factors. So the first thing and most important is your payment history. So if you have loans, if you have credit cards, how often are you making your payments on time, right? Are you paying more than the minimum amount, and how long have you been in good standing with those credit cards? That's 35% of your credit score right there, okay? And then the amount of actually credit that you have on hand and that you're using, that makes up 30%. So there's 35% for your payment history. 30% of your credit score is, the available credit. So what you don't want to do is, have credit cards and have available credit and you have them, maxed out. Ideally you want to use less than about 30% of the credit that you have available. You want to keep, the amount of money that you borrow on your available credit under 30% at least. The lower that number is, the better it is for you. And the banks aren't as worried about loaning you money, or lenders aren't as worried about letting you borrow money, because you have a history of paying. You're not overextending your credit, right? You know how to handle your credit, and you're making the payments. Your payment, or your length of credit, how long you've had credit cards, or how long you've had your credit, your history, is about 15% of your credit score. Okay. So I know a lot of people say, well, I don't want credit cards, and they end up closing their credit cards, or closing cards, small credit cards that they had way back when. But, sometimes that can be detrimental to your credit score, because what you've done is you've eliminated some of the credit history. So if you have credit cards that you've had for like 10 and 15 years, or, other credit that you have extended, that's, 10 or 15 years of history or more, you want to keep those. You want to keep your oldest credit cards, or your oldest, the ones you've had the longest. You want to keep those open, because that's really helped you build your credit history. And that's it's a big factor in your credit score, is how long you've had credit, how long you maintain your credit, and how long you've been paying on that credit. If you are out there and you're trying to open new credit cards or new accounts, often that's going to be a hit on your credit score as well. That's about 10%. New accounts, and recently opened accounts account for about 10% of your credit score. And then the other thing you want to have a good mix of credit. You just don't want revolving credit, or you just don't want term credit. You want to have a good mix, because again, that allows the people or the institutions that are lending you money, it shows them that you know how to manage, the different types of credit. And by doing so, you are a better fit, or more likely to, pay your debts off in a timely manner. So they're more likely to lend to you for that. So those are the components of your credit score. So your payment history, 35%. The percentage of available credit, 30%. The length of your credit history, how long you've had your credit, is 15% of your score. 15% of your score. If you're opening new accounts, that's 10%. And then your mix of credit is another 10% of your credit score. And just a side note, just a personal story, I myself, have, dealt with credit and credit score issues. And I was, for the longest time, I did not have, I had my credit cards, but I didn't have any other kind of loans or term loans. I had actually had some, high amount of debt on my credit cards. And so just through course of just learning and educating myself, I took out a personal loan, right, which was a term loan. And I took the money that I got from that and paid off my credit cards, right? So on my credit score, now I have the revolving credit, obviously the credit score. I've paid down my credit. I've paid those cards off. And then I also have a term loan on my credit score, and my credit score jumped 100 points. So knowing and understanding, how this credit score works is really important for the future, because if you want to borrow money, the higher your credit score is, right, the less money you're going to have to, the lower your interest rate is going to be, which means that you're going to pay, less money and interest on those loans. So that's just a little personal side note that I thought I would share with you. So you have your credit scores, and now you have your credit reports. And your credit report is just as, information that is shared to lenders about you. So in your credit report will contain your social security number, your date of birth, the addresses where you've lived, where you live now, where you've worked, um, your borrowing and repayment history. So, have you been paying on time? Any inquiries? So, have you been looking for loans? And if you are, getting inquiries, if there are inquiries into your credit, like you're asking for getting credit applications or credit card applications in a, short period of time, that's can ding your credit score, unless it might be a car or a home. If you're looking for a car or a home, you want to have all those inquiries within a certain amount of time, like within 2 weeks, rather than one every other month or something like that. And then your credit score, your credit report also reports any criminal issues that you had, tax or accounts that have gone into collection. If you've gone into collection too, that's a big hit to your credit report and your credit score as well. Okay. And so these reports and these credit are used for more than just borrowing money. I think that's something that a lot of people don't know or aren't aware of. So there's some lenders, but then also if you're looking to rent a home, a lot of employers now will pull your credit report just to check and see, again, your criminal history. If you're in debt, there could be some red flags, and particularly if you're working, say, in, the financial sector.
Question for
Insurance
you,
companies
Lamarco.
Yes.
So you mentioned in your credit report, this goes back how many years?
Oh, I'm sorry. It goes back 7 years.
I knew you said that, but I just want to make sure, because that's really important. If someone does have, if they've learned from the error of their ways, so to speak, and maybe you did go to collections. But so if that happened, say 14 years ago, is that then removed from your credit report?
Yes. I don't know if I'd necessarily removed, but that period of time that lenders access is for 7 years, so it wouldn't be on your credit report.
So you're not doomed.
And
I want people to know. I want
Right.
people to know they're not doomed, right? You can, there's that youthful indiscretion, so to speak, that happen, that people have gotten into trouble, but they're able to repair their credit history. And so, I really love the example that you gave, but that is a way to do that by making sure you're paying your rent payment on time, making sure that you pay off the credit cards, those types of things, and not with another credit card, right?
Exactly. I mean, unless you have a high amount, high interest, and then there's a credit card that's running a great deal, and maybe it's like 0% down or 0% interest for a year. You want to, if you can, swing it. I mean, it might be advantageous for you to take that deal and to really pay off that credit card and don't run it up again, or don't run the other one up.
Yes, that's great advice, though, because sometimes you'll go to your credit union or your bank, and they'll say, "Oh, just letting you know, we have a deal that goes for a year, and it's no interest," or whatever. So rather than say, "Oh, I don't need any more credit," maybe finding out that and ways that you can do that to your benefit. That is a great point.
Yeah. You just you have to explore. I mean, you be open, but just really understand, is it manageable, and what are your goals with it, and do you really need it? Yeah.
Good advice.
Thanks. That was a great question.
Yes. Also, I wanted to say, anyone who's watching right now, if you have a question, please put it in the chat or the Q&A, either one. Happy to do that. In fact, we have somebody right now that just, so thank you for sharing. I love that when we truly have a conversation. And in the chat, it said, "I went bankrupt at age 25 after hospital bills from having a baby." And I will tell you, medical bills are a common common one when people get into bankruptcy and other problems. I bought my house at age 28. Those hospital bills cost more than my house. Oh my goodness. Yes, that is exactly what can happen. But I love her last point, and she said, don't give up, you can fix it. So that is so great.
Amen.
Don't give
Amen.
up. And that might
And I
be
will say
denying
that,
yourself some, you don't have the latest, greatest shoes, but you also don't have the latest, greatest debt. And that's a great feeling.
yes, yes. And I know that there are some leniencies now with medical bills, what goes on and what doesn't go on your credit report or your credit score. So for those out there that may be in a similar situation, or the same situation, maybe just do some research and look and see. I'm not saying don't pay your bills, but then just check and see. And then there's also, when you get in trouble, a lot of times, if you reach out to the people that you're indebted to, or to the collection agency, or hopefully before the collection agency, reach out to them and tell them the situation and try to work something out, and
A
see if
payment
they'll
plan or,
work with you. Hopefully they will. Yep.
because at the
And
end of the day,
tend
they
to
want their
be,
money. And if
exactly.
and that's the easiest way to do that, you two can work on a payment plan.
Mhm.
That can even happen in college, that there are, rather than one lump sum tuition, there may be payment plans, but you have to investigate that. So you do have to advocate for yourself some. No one's going to come up to you and pat you on the back and say, I hear it's really tough for you right now, so let me do this for you. You have to advocate for yourself. But by doing that, chances are they're going to work with you.
Yes, exactly. That's it. I mean, don't be afraid. It can be daunting. It really can be. Like, you have this amount of debt, and sometimes you have collectors calling you and they're threatening to take this, that, and the other. But there are things that you can do also to make sure that, to make them stop those calls and threatening you too. And maybe that's something we can talk about, another time as well. How do you, if you're in trouble, how do you handle it? How do you talk to your creditors? But there's a lot out there. And then also, I will share, there's the Money EDU that talks about some of this stuff, and we'll work with that. Holly and I will get you up and running on that too, just information on that too. But I'll show the link at the end. But there's stuff in there that covers, talking to your creditors as well.
And also making out a plan that you can live with. I mean, sometimes,
yes,
if you make a plan and you can't possibly pay that, then that's not a plan. That's not a workable plan.
Mm-hmm.
And that would be another great piece where Money EDU comes in, is budgeting and figuring out what you bring home and what you're paying out, and how much you can afford to pay.
And all of that goes, all goes hand in hand. You want to have a lifestyle where you're living, but you want to make sure that you're taking care of your needs before you take care of your wants.
Oh, that's so true. I love that line. Love that line.
Oh.
I have another from the chat. One other one said, correct. All things younger me did not know. Oh, yes. Yes, it's so true. Bill collectors were mean. Much older and wiser now, and happily employed at Twin Star, and thankful for resources like these. Thank you, Lamarco. So true, because that whole younger me, if we could have a conversation, younger me, I would tell you a few things. But so that's why we just really encourage you to have a conversation with your family, your kids,
yes,
so that they can benefit from what you didn't know. Maybe someone didn't have that conversation. And so do have that conversation, and start small so they can learn that. That's the other thing. Kids get out of college and then they try to buy a car, they get their first job, they have no credit. And so, that you can't, even though they'll say, but I have a job. That happened to my son. He graduated from college. He's in the Army. He goes, I have a guaranteed income, right? This is good for 7 years. But he couldn't, he wanted to which I appreciated. He wanted to pay his own cell phone bill, but he couldn't at the place that he had had it before. He had no credit. And so there is that piece of establishing credit, so good for kids, but not getting into, it's a balance, not getting into trouble.
It's definitely a tight wire act when you're young. Yeah, and we'll talk about some of that too, like the establishing credit, things that people can do to kind of get them going, starting out. And I it's good. It's good stuff.
Good. Well, I'll let you go. I'll let you continue, right? Rather than
no, I
keep
appreciate the
interrupting.
conversation,
But
and I
it's
appreciate
just such
the chats.
important.
Thank you everyone for the questions. All right, so the one thing I wanted to say about this one too, I know that the insurance companies on here in Washington State, though, their insurance companies are no longer able to use your credit report to establish your insurance rates. So other states, they still may have that, I guess, rules, but here in Washington State, they don't. And so we talked about the credit reports, and then these are the three credit reporting agencies. So there's Experience, TransUnion, and Equifax. Okay, and what you want to do each year, you are allowed to see your, I said see, right? Review your credit report, and you can visit annualcreditreport.com. And you want to make sure that when you look it over, you want to make sure that your address, your name, and everything is right on there. You want to make sure that there are no surprises, like I don't know, credit cards that you didn't open, and you also want to make sure that if you have credit and you've been paying it off, your credit cards, that that you want to make sure that they're reporting that. You want to make sure that your credit history is there. Your payment history is there and is being reported, because that's, like, again, the biggest factor that goes to your credit score. Coincidentally, another thing that happened to me is a few years ago, I was reviewing my credit score and found out that somehow, some way, magically, I was living in Miami, Florida. So I had to go through, the different bureaus and say, hey, this isn't me. I had to prove that it wasn't me. And once I did, that address was taken off. So I didn't know if anyone tried to use my name for something or anything like that, but there was nothing else, that was on my credit report that I hadn't put there. But so you definitely want to check your credit report, at least annually. With these companies too, you can also have, you can pay for a paid service where you can check it, so you have access to your credit score, year round. But that's your decision. If I would say, though, if you've had an ID fraud or ID theft, that might be something that you want to look at. So, here we go. So you want to make sure when you get access to your credit report, you want to make sure that everything on there is right. The information, we just talked about that. Your payment histories, you want to make sure that there's no errors that are on there. Like in my case, I had to dispute that I'm not living in Miami, Florida. And then, so those are the things that you want to do when you look at your credit report and check it out. Just make sure that everything on there is truly, you, and every account on there is, account that you've opened. So in there are cases when you find some inaccuracies or accounts that aren't yours, you want to make sure that you contact the credit bureau and tell them, like, this isn't me, and they're going to ask you, and you'll want to put a freeze or a lock on your account. And so, with freezes and locks, there are a slight difference. Basically, with the freeze, right, no one can pull your credit reports. So lenders can't access, can't OK loans or or can't put a credit card in your name, so you can't get a credit card. So you'll have to reach out to them and let them know that you want to open up your credit report to let others have access to it for a period of time. And then, but the key difference between the freeze and the lock is that the freeze is faster and easier to lift than the lock is. So, I mean, credit freeze. Yeah, it's easier to lift a credit lock than a credit freeze. And the credit locks are typically like the companies, where you pay for the service, and then when there are inquiries into your credit, or you use your credit card, you will get a ding on your cell phone or a device to say, is this you? Did you grant or did you apply for this account? And then you just put yes, hit yes on your app. And so typically it's a paid service, whereas the freeze is free, but you're dealing directly with those credit institutions, or you're dealing with the credit report services. And you have to let them know that you would like your credit to have access over this certain period of time. Typically, so if you're applying for a job, or if you are going to look for loans or mortgages, you'll have to let them know. And then here we go again. So the lock, again, no one can access your credit report without you taking those extra steps, by either contacting your credit bureau or using the app. So they're good for. It makes it difficult for thieves to open new credits in your name. The cons is that especially for the freeze, you have to definitely you have to reach out to the bureaus each time to let them know that you would like others to be able to access your credit. But typically, if you've been a victim of identity theft, this is a service that you want to use, because what these will do is that they'll explore and see if they are able to open an account. And if they're able to open up one account, then they're going to open up, maybe try to do 10 or 15 in your name. And then also what they do is they will hold on to your information for a while after they've stolen the identity, so maybe over the course of a year, and then they'll try to open that account and explore. And if you're not aware of it, you could have some very bad things happen. Actually, I think it was about maybe 2 or 3 weeks ago, we were at a business, and this gentleman said that he had his identity stolen, and then within the course of, I think he said 48 hours, $58,000 had been taken from his accounts, or it had been run up on a credit card. So if you have a credit lock, or if you have a credit freeze, he would have been notified, which I'm surprised that he wasn't to begin with. If there was such a large amount of money in a shorter period of time, it seems like an institution would have reached out and let him know. And so this is the part where we're talking about the building and the maintaining your credit. So if you're trying to reestablish your credit, or if you're just starting to get out there and to establish credit, things that you might want to do is you might want to look at a secured credit card, which is a credit card where you actually pay the balance ahead of time. So if you want your credit limit to be, say, $500, you'd pay $500 for that card, and then you use it as a credit card from there on. You use it as a regular credit card. You'll charge and then pay at the end of the month. All right. And so what that does is it's reporting. You're reporting to the credit agency each month. You are establishing your payment history. You're establishing your credit history. So everything a credit card does, that does, but you're securing it by putting money up front, putting that $500 up as collateral. And then once you are done, or the bank feels like that you've established enough credit and you're trustworthy enough, oftentimes they'll free up that $500. They'll let it go to a payment, or they might even give it to you in cash if you ask for it that way. Or you can have, maybe you can have someone co-sign on an account, or you can co-sign on someone's account. But you have to make sure those people that that you are co-signing on, they have to trust you. Because if you don't pay the debt, then they're responsible for that debt. And so that could lead to a lot of lost friendships or a lot of family conflict. So you want to make sure that, you are trustworthy, and you really, take their support and their help wholeheartedly, because that's what they're doing. They're helping you build your credit. So you don't want to, do them wrong. Again, want to make sure that you pay all your bills on time. You want to make sure that, whatever they are, utility bills, anything, pay those bills on time and pay them full if you're able to. And then when you do get your credit, or when you do get credit cards, don't just go out there and spend it and buy everything. You want to be wise, right? You want to be wise with that credit, because the amount of credit that you have used versus the amount of credit that you have available to you is something that's 30% of your credit score as well. So when you choose a credit card, right, you want to make sure you want to choose the card that fits your needs and fits your desires and your wants. Obviously, probably the interest rate is something you'll want to look at. The lower the interest rate, the better it is. Some of these cards, though, they have introductory rates again, so they'll maybe a really low rate at the beginning, but after the certain amount of time, that rate goes to 20, 25%, 30%. So if that's the case, again, like we were talking about earlier, if you have a lot of debt and you transfer your debt onto a new credit card with a low interest rate, make sure what are the terms of that card, how long is that introductory period, what does the interest rate go to afterwards. And if you don't pay off that card in that time, do you have to pay off all the interest or opposed to the interest that you have on the balance at that time. Some of the credit cards have incentives. So again, the mileage, a lot of airlines have, mileage. You get mileage for your for using the cards. So you want to make sure that whatever card you choose fits, where you're at financially, and the desires that the purposes that you want to use it for. Is it to help pay for travel costs if you plan to travel a lot, or is it to get out of debt, or is it to have an emergency backup just in case something happens really, in your life, or you need money now but you don't have cash on hand. All those are factors that go into deciding what credit card you use. And once you get your credit card, right, things that you want to do, you want to make sure that you look at your statement each month, not just how much you have to pay, but look at each one of the transactions again and make sure that those are your transactions. Make sure that, the full amount of the payment that you made is applied. Make sure that it was applied on time. So if it wasn't, if there's a late fee, and you paid it on time, let them know that you paid them on time. Sometimes, being on the West Coast, a lot of these institutions are on the East Coast. So if it's after, maybe 8 or 9 o'clock, it's that payment is, entered into the next day. If that's the case on some of your payments, maybe you just give them a call and say, hey, I made this payment on this date, but it's shows up the next day, and so therefore I was charged a fee. Can we work something out? And typically they'll say yes, maybe once or twice. But once so you can't abuse that. Don't abuse that. Be really cautious on how you do that. But again, talk to them and let them know. You want to pay more than just the minimum payment of for that month. You want to make sure that you want to pay at least, it'd be nice to at least pay twice the minimum amount, because that way again you're saving on interest. You're not paying as much as interest, and you're really working to bring down the available, your debt availability, the amount of debt that you've incurred versus your credit limit. And if you have problems, and this is a big one, if you can't make payments, or you just can't make the payments, then maybe something came up, and medical bills, for example. So reach out to the lender, reach out to them before you need to make that payment, and say, hey, I have some things coming up in my life. I'm not going to be able to make this payment. Can we work something out? Because I've worked hard to establish my credit. I'm really doing good here. I don't want to take that hit. What can we do? And they'll work with you. I promise you. Well, I hope they will work with you. If they're, you just hope that they would work with you. And typically they will. I promise you that. Just speaking from experience, they will work with you. Okay. And then you want to look at that credit report each year. Another thing you can do is, just so you don't miss those payments, or so you don't pay that, that bill at 9 o'clock and it goes to the next day, is you can set up automatic payment, right? Through your banking institution, with your credit union or your bank. You can, set certain times each month, certain day each month that you want to make payments. This is typically good too. This is good also if you say, if you you get paid every other week. I'm sure the biggest chunk of that first payment is going to be house payment, and you may not be able to make that full amount on a credit card if it's falls within that same period of time. So maybe you can establish and set up, you pay the minimum payment from that check, so you're still paying on time, right? And then the next week, or and then the following paycheck, when you have more cash that's freed up, you make a second payment, so that you will pay more than just that minimum amount, again saving you interest, and you're paying, bringing down the amount of debt that's on that card. All right, so those are kind of some strategies. That's something that you can do as well. And so once you have your credit, once you've established your credit, you're doing good, to help going and stay in good standing with banks and lending institutions. You want to pay your bills on time, and if you have the availability, pay it off in full. And I'm talking about the revolving credit, right? Because with the installment credit, right, or the installment loans, you have to make that certain amount of payment each month, okay, unless you refinance or you talk to your institution. But with the credit cards, it's a different story. So pay those off in full, pay those each month. Again, when we talk about the available credit, keep that under 30%, so not the available credit, but make sure that, do your best to borrow less than 30% of your available credit, to help you maintain a great credit score. And I mean great credit score. All right. And if you've been a rock star, making your payments on time, paying more than the minimum wage or minimum amount, all right, and you're doing good, you have an income that you can support it, you can ask to raise your credit limit, right? So maybe you're taking those vacations. Vacations cost a lot more money than, than just, driving around around town and eating, around town. So you're going to spend more money, right? But if you increase your available credit, if you increase your credit limit, then that increase in lifestyle, those increase in purchases, are not going to affect that credit availability, that 30%. So if you want to make sure that you increase that credit limit so that you're able to still have a positive credit score. And then try not to open new accounts, on a regular basis. Stick with the credit cards that you have, roll with them. They've gotten you this far. If you need more credit, ask if you can increase your credit as opposed to opening up a new account. And so we've talked about the installment loans versus revolving credit. And so with the installment loans, generally they're, for bigger purchases, they take longer to pay. And then all the debt is front loaded, right? We talked about credit reports and credit scores. What makes up a credit score? What's in your credit report? How to maintain it? How to and the importance of reviewing your credit report and your credit scores. All right. We talked about identity theft, what to do if you see on your credit report that there are accounts that you didn't open, right? Reach out to your credit bureau, put a freeze or a lock on your credit report, limit who can access it. And then we talked about building and maintaining and establishing, building and maintaining your credit, the steps that you need to do that. All right. So I guess that is it for me. That's everything I have. Are there any questions out there?
I'll give our folks a minute or two to ask a question if they have one. Thank you so much. That was a wonderful presentation and so many great things to think about. I often think when I go to a store, the store's job is to sell me credit. That's their job, right? So just because they say, well, you're pre-approved for XYZ at this store, doesn't mean you have to say yes. And so maybe saying no is a great idea.
It can't hurt. It can't hurt. And typically when you do go to like the stores, when you get a store card, that they're going to have the higher interest rates. They're a lot of times they're the ones that have that low introductory rate. And then after that introductory rate, it's like, boom.
Yes, but they hook you by saying, oh, you're save 10% off your purchase today. So you want to say yes, but easy, you can say no thanks. I got enough credit. I got enough.
Yeah.
Well, excuse me, I have a cough. I don't see any other questions or comments in the chat or Q&A. Okay. So I guess that you did such a great job that you answered everyone's question.
Oh, I hope that's the case. Sometimes I get on a roll and I just start rambling because I like talking about this. And as I learned more, I just want to share more because, I'm someone that had been in trouble with credit cards and debts and especially with the students and with the kids, getting into good habits early is going to save you, tens of thousands, if not hundreds of thousands of dollars over the course of your lifetime. I promise you.
Amen to that. And so someone from our audience said, yes, all in capitals, and thank you. So we'll leave it at that. But thank you all for joining us. We are thrilled to have you next month, just to let you know, on June 14th is a wonderful opportunity to understand insurance. I know that everybody who started a job got something in tiny writing and they're having to choose and they don't even know what they're choosing. So understanding insurance will be our topic for our financial wellness series next month. I see that you put the Money EDU and Twin
Yes.
Star Credit Union phone numbers up in case you have any questions or you need help. If you need help, it is free. Please do talk to someone rather than suffer in agony. That is not fun for anybody. So if you need help, and we've got some wonderful resources there for you. And then we're going to actually show you how to do Money EDU. That will be another on our playlist. That'll happen after our Understanding Insurance. But thank you so much for joining us. Next week, we'll do this all again in Spanish. So if you have friends that need it in another language, please join us next Tuesday. All right, until then, be safe, be well, everyone, and we'll see you next time.
Awesome. Thank
All
you
right,
so
thank you.
much.